All right, here's our financial overview of Macy's. And we're going to take a look at some income statement issues, some credit rating issues, and then what we think the market thinks of them, and then potential opportunities. So first, we'll take a look at revenue, and you're going to see a series of charts here where it goes from 2022 to 2025, and then the far right bar says trailing 12 months ending October 31st. So each of these years ends January 31. Their fiscal year end is January 31. So this is ending January 31, 2025 in the prior year. This ends October 31. Obviously, we haven't made it to the end of January yet. So this is the October 30, the fiscal year ended October 31. So it includes one quarter of 2025, but it does give us a little bit of comparison for 3 quarters of the 2026 year. So when we look at this, revenue is coming down a bit, not a lot, a little bit. Maybe that may be coming, some of it may be coming from them closing stores, but all in all, it looks like revenue is generally flat. Then we look at their gross profit percentage, which is just the profit they make off the sale of actual profit and not including any overhead expenses. It's pretty, they've done a nice job of keeping this pretty flat in here, right at about 40%. You know, this scale only goes 39 to 41%. So this is pretty flat. They've done a nice job of holding on to their gross profit percentage, not having to discount product too much to unload it. So they've held their gross profit percentage while their revenue has come down a slight amount over time, over the last 4, almost 5 years. Done a good job of holding operating expenses pretty steady and brought them down a little bit here in the last couple of years. One very promising thing is their interest expenses come way down. The problem for a lot of these retailers is they build up a lot of debt, and then when they run into operating issues, they can't pay the debt and they end up in bankruptcy. And so they've done a nice job of reducing their interest expense, especially as interest rates ran up here after COVID. And one of the reasons why their interest expenses come down is because they're basically paying down debt. Last 5 years they brought it down by $1 billion, but all in all, they have done a nice job of bringing debt down and reducing their interest expense, which is going to help with their long-term viability. And then if you look at the credit ratings from the three main services out there, Moody's, S&P, and Fitch, they're right borderline. They're borderline right at investment grade. S&P has them at investment grade. Moody's just below, and Fitch just below. And I did look at these. They've all been bumping their credit ratings up lately. So they were lower in the previous years than this. But not quite investment grade with all three of them, but they're getting close and they're moving it up. The market likes what they're doing. This is their stock price over the last 5 years. And, if you look at from kind of the end of 2021 to the first part of 2025, all in all, it was down. But in the last, 6 months or so, the market views their operations as favorably. They bumped their stock price here from, around $12, $11 up to 22, over almost $23. And this is as of basically yesterday. So the market's viewing what's happening there favorably. They probably have released some information about what's happened over the holidays here, and they may have had good sales figures, but I haven't gone and looked at that. But we won't know that from their financials until about the end of February, when they close their quarter at January 31. Then in about 30 days later, they'll release their annual or quarterly sales figures. But the one thing I do want to point out here is there's a lot of potential opportunity here. The market capital, the overall basic value of Macy's is $6 billion. And they've got a big brand name. If you look at Target, they're at $46 billion, and Walmart at $899 billion, and then Amazon is in the trillions here. So I'm only bringing this slide up to just show that if they're able to turn their operations around and come up with a good strategy, there's plenty of market cap out there that they could capture from other retailers. So there's a lot of opportunity out there. You know, if they get between, you know, above target, it'd be 10 times the value, and that'll drive their stock price pretty high. So just to summarize, it looks like operations are stable. They're improving their long-term outlook with their debt reduction. The market recently in 2025 is viewing them favorably, and there's a lot of opportunity to increase value there and capture value from some of their competitors.